Did you know that over 90% of active fund managers fail to beat the market? Shocking, right? And yet, the world of value investing holds the secret to consistent success. The truth is, the stock market isn't just about buying and selling based on short-term trends. It's about finding long-term gems, undervalued companies that can deliver incredible returns over time. In this video, we're going beyond the basics of value investing. We're diving deep into strategies that top investors like Warren Buffett and Charlie Munger use to spot hidden opportunities. This isn't your average, buy low, sell high advice. We'll explore how to find value in the most unexpected places, whether it's overlooked data, market panic, or growth stocks that others don't see as valuable. Stick with us, and you'll uncover how to spot the next big opportunity before everyone else catches on. From hidden financial signals to the psychology that keeps investors focused, we're going to reveal what most don't know about finding true value in the stock market. Ready to take your investing knowledge to the next level? Let's dive in. Chapter 1. The secret sauce of margin of safety. Beyond the buzzword, margin of safety is a term we often hear in value investing, but what does it really mean? Most investors think it's simply about buying a stock at a discount to its intrinsic value, but there's much more to it. The key isn't just about finding cheap stocks, it's about ensuring that the stock has room to fall without losing your initial investment. Think of it as buying a house at a price below market value, but still leaving enough cushion for repairs. Benjamin Graham, the father of value investing, emphasized that margin of safety isn't just a number, it's a mindset. He suggested that when you're estimating the value of a company, you should always factor in potential errors in judgment. No one is perfect, and no prediction is foolproof, so it's essential to have that buffer in place. But here's the twist. Margin of safety doesn't always have to be about price. It can also be about the business itself. A company with strong cash flow, a steady customer base, and a consistent product will face fewer risks. That's why looking at a company's fundamentals, like earnings stability and low debt, is critical. Even if the stock price fluctuates, the business can withstand economic storms, protecting your investment. To dig deeper, consider the companies that survived the 2008 financial crisis. Firms like Coca-Cola and Johnson & Johnson continued to perform well, not just because they were undervalued, but because their business models had a natural margin of safety built in. These companies had economic moats, a concept we'll dive into later, that made them more resilient. So, what's the takeaway? A margin of safety is a combination of price, business stability, and long-term prospects. It's the cushion that helps you sleep well at night, knowing you're protected from market crashes and unexpected risks. As Warren Buffett famously said, price is what you pay, value is what you get. The key is ensuring that the value you get is a lot more than what you paid. Chapter 2. The power of contrarian thinking. Value in the eye of the storm. Contrarian thinking is the backbone of value investing. While everyone else is selling, a contrarian investor is buying. It's about seeing what others don't, and being willing to take action when the crowd runs in the opposite direction. But what makes contrarian investing so powerful? Simply put, the market often overreacts. It's human nature. When fear takes over, prices can drop below intrinsic value. Take the example of the 2008 market crash. Many investors panicked and sold, but Buffett saw opportunity. He bought Goldman Sachs and General Electric, two companies that were undervalued due to widespread fear. In 2009, Buffett himself said, "Be fearful when others are greedy, and greedy when others are fearful." This is the essence of contrarian investing. When others are afraid, you need to think critically and buy. The trick to successful contrarian investing is to remain calm and do your homework. You must understand the fundamental value of the stock, not just the market sentiment. This is where the concept of market psychology comes into play. Many times, stocks are undervalued because the public is overly concerned with short-term events. However, if the company's fundamentals remain strong, these short-term drops can present an opportunity to buy at a discount. Let's look at the 2020 stock market crash during the early days of the pandemic. Investors were dumping stocks left and right, but some saw this as a chance to buy high-quality companies at low prices. Those who took a contrarian approach, like purchasing companies with strong balance sheets and growth potential, are now seeing great returns. Research by J.P. Morgan shows that the S&P 500's average return after a market crash is 100% over the next 5 years. This shows the power of buying when the market is in panic mode. Contrarian investing isn't for the faint-hearted. It requires a certain level of conviction and patience. But if done right, it can offer huge rewards. The key is to ignore the noise and focus on long-term value. As John Templeton put it, the best time to buy is when there's blood in the streets, even if the blood is your own. Chapter 3. Economic Moats. Digging deeper into sustainable competitive advantages, Warren Buffett's success can be attributed to his ability to spot companies with wide economic moats. An economic moat is a competitive advantage that protects a company from rivals, much like how a moat protects a castle. This concept is crucial for value investors because it ensures a company's ability to sustain profits over time. But what exactly makes an economic moat? It's about finding businesses that are difficult to replicate. Think about Apple's brand loyalty or Coca-Cola's distribution network. These companies don't just sell products, they sell a unique experience. This is what makes their moats so strong. They can raise prices, yet their customers will still buy. Research by Morningstar shows that companies with wide economic moats tend to outperform the broader market. From 1995 to 2015, Morningstar found that companies with strong moats delivered annual returns of 9.3%, compared to 6.3% for the S&P 500. That's a difference of nearly 50% over 20 years. So, finding companies with these types of advantages is key to long-term investing success. There are several types of moats to consider. A cost advantage means that a company can produce goods more cheaply than competitors. Walmart, for instance, can sell at lower prices due to its vast distribution network. Another moat is the network effect, where a product becomes more valuable as more people use it. Think of social media platforms like Facebook or Instagram. Finally, there's the intangible asset moat, which includes brands, patents, and trademarks, Coca-Cola being the prime example. The real trick is identifying these moats before they become obvious to everyone else. Often, businesses with strong moats don't appear like the typical growth stocks. Instead, they are undervalued gems that the market overlooks. This is where patience comes in. Companies with strong economic moats might not skyrocket overnight, but over time, their ability to fend off competition and generate cash flow will make them worth the wait. In conclusion, an economic moat isn't just a nice feature, it's a requirement for a successful investment strategy. As Buffett wisely said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. If you're finding this information helpful, make sure to subscribe for more deep dives into value investing strategies and tips you won't find anywhere else. Chapter 4. Unseen Signals. How to decode the invisible data of value stocks. In value investing, the most valuable insights often come from data that's overlooked. Many investors focus solely on price and earnings reports, but what if the real hidden signals are more subtle? By understanding the less obvious data, you can uncover opportunities others miss. These hidden signals could be in things like a company's supply chain, management changes, or R&D investments. One example of overlooked data comes from tracking changes in management. Companies that bring in fresh, capable leadership can transform a struggling business into a powerhouse. According to a study by McKinsey & Company, companies with management changes often see a 15–20% improvement in stock performance after the leadership shift. This insight tells us that the right leadership can be a hidden value driver that impacts long-term growth, even if it's not immediately reflected in the stock price. Another critical but often unseen signal is R&D investment. While many investors focus on a company's quarterly earnings, they overlook the long-term value of innovation. Companies that reinvest their profits into research and development tend to outperform over time. The average R&D spend for successful companies like Amazon or Google is substantial, and this focus on future growth often goes underappreciated by the market in the short term. Let's not forget the importance of understanding a company's supply chain dynamics. In 2020, many companies with resilient supply chains weathered the pandemic better than others. Companies like Procter & Gamble and Apple, known for their robust supply chains, were able to adapt and continue to generate profits. This is an example of how operational efficiency and supply chain strength can be overlooked but have a lasting impact on a company's success. In addition to these signals, investors can also look for signs of insider buying. When executives buy stock in their own company, it can signal confidence in the company's future. A study by the Harvard Business Review found that insider buying often precedes a stock price increase by an average of 5–6%. This is valuable information that could lead to significant returns if spotted early. Investors should also keep an eye on market sentiment indicators that aren't always captured in financial statements. For example, changes in social media sentiment and customer reviews can give early clues about a company's product adoption and growth potential. Analyzing this invisible data is how investors gain an edge in uncovering value stocks that are still under the radar. Subscribe now to continue learning how to decode hidden signals in the stock market and uncover gems others might miss. Chapter 5. Psychology of Value Investors. Tuning out the noise. One of the most underrated aspects of value investing is the psychological discipline it requires. It's not just about picking the right stocks, it's about staying calm and sticking to your strategy when the market is full of distractions. In a world driven by instant headlines and social media hype, how do successful value investors stay focused on the long term? The key lies in ignoring the noise. When the market is volatile, it's easy to panic and make rash decisions. But the best investors are able to detach themselves from short-term market movements and focus on the intrinsic value of companies. As Warren Buffett often says, the stock market is a device for transferring money from the impatient to the patient. Buffett himself is a master at this. He once famously held onto a stock like Coca-Cola for decades, despite short-term fluctuations. He understood that the intrinsic value of the company was far more important than market sentiment. This mindset of being patient and thinking long-term is what sets value investors apart from traders looking for quick wins. Another valuable lesson comes from Charlie Munger, Buffett's longtime partner. Munger once said, "The big money is not in the buying or the selling, but in the waiting." This patience is a central tenet of value investing, and it helps you avoid the temptation of following the herd when the market gets turbulent. Psychologically, it also helps to develop a circle of competence. By focusing on industries and businesses you understand, you minimize the emotional impact of market fluctuations. Knowing what you know well helps you make confident decisions when others are uncertain. Peter Lynch, one of the most successful fund managers of all time, said, "Know what you own, and know why you own it." This principle is crucial for maintaining composure in the face of market volatility. Sticking to your strategy is a test of emotional control. One of the most famous investors, John Templeton, stressed the importance of contrarian thinking and ignoring market panic. "The four most dangerous words in investing are, 'This time it's different,'" he said. Recognizing that history often repeats itself allows investors to stay grounded and avoid buying into emotional hysteria. Being able to tune out the noise also requires confidence in your own research. When you do the work to understand a company's value and its long-term prospects, the noise of the market becomes less distracting. You start making decisions based on facts rather than emotion. If you enjoyed these insights, be sure to subscribe for more strategies on how to stay focused, make smarter decisions, and master the psychology of value investing. Chapter 6. Hidden in Plain Sight. How to find value in growth stocks. Value investing isn't just about buying established, undervalued companies. It can also involve finding hidden value in growth stocks. Many people assume that growth stocks are only for risk takers or traders, but there's a way to apply value investing principles to them as well. This strategy involves finding companies with strong growth potential that are undervalued based on their future prospects. The key is to look beyond the current earnings and focus on the company's future potential. For example, investors who bought Amazon in the early 2000s saw it as a growth stock, but its value lay in its long-term vision for dominating e-commerce. If you had only looked at Amazon's earnings in 2001, it might have seemed overpriced. However, recognizing its future value, those who invested early were able to reap massive rewards. Another example is Tesla. In its early years, Tesla was viewed as a risky bet. But value investors who recognized its potential to revolutionize the auto industry saw it as an opportunity for long-term value. Today, Tesla's growth has far exceeded what most analysts anticipated, making it a prime example of hidden value in growth stocks. One critical factor in finding value in growth stocks is understanding the company's market positioning. Growth stocks that dominate their industry or create entirely new markets have a unique opportunity for long-term value creation. For instance, companies that create network effects, like Facebook or Google, are especially valuable in the long run because their growth tends to snowball once they gain traction. Growth stocks can also be identified by looking at the strength of their intellectual property. A company with strong patents or proprietary technology has the potential to generate huge value in the future. For example, Microsoft's software dominance or Apple's innovative product designs were once overlooked as growth prospects. But those who invested based on their long-term value saw significant returns. The trick to spotting these stocks is to look at them from the perspective of long-term sustainability. A stock that might seem overpriced today could be an incredible bargain if it's positioned to dominate a market over the next decade. Like Google, which was considered expensive when it first went public, but was ultimately undervalued because its market potential was misunderstood. Subscribe now for more insights into how to find hidden value in the most unexpected places, including growth stocks that could be your next big investment.